When you are on a job, it's very difficult to get rich. So how exactly did that happen for you?
You have to think differently. Some of the stocks that I invested in have been up 20, 30 times.
Wow.
The ability to take risks, be able to lose money, allows you to make a ton of money.
What does your portfolio look like in terms of geographical diversification?
If you are not bullish on India, you're doing yourself the biggest disservice. We've seen a time when manufacturing in this country of any scale was zero. And from there to today, nearly 40% smartphones that are used in US are manufactured in India. This country is going to go places unless we shoot ourselves in the foot again.
So how could we shoot ourselves in the foot? All right. Hi Anshul, welcome to the 1% Club Show.
Hi Sharan, it's my pleasure. Thanks for having me.
You are today what the industry would call as an ultra HNI, UHNI. And I know that you started from zero. Let's talk about where you've worked and what you've done. So you have almost 20 years of experience in the markets. You've been the head of PMS and CIO at Kotak Mahindra AMC. You have experiences across companies like JP Morgan Chase, ICICI Bank, and Standard Chartered Bank. And today you are managing Saigal Capital, which is your family office, which is basically your family's entire net worth.
That's right.
So let's start with how exactly you became an ultra HNI, right? Like, because the first thought in my head is that, was your dad rich? Was it from your dad's money? So let's start from there.
I can tell you that there is an order of magnitude increase, and I did not take money from my dad. This money that I kind of built, and this is our capital, this is money that I built ground up.
Oh, you were from zero?
Zero.
Okay.
And of course, on the side, I was investing for my dad as well, his money.
Yeah.
And that again, that wasn't like substantial capital. That was a very small amount of capital when I received it. Somewhere of the order of say 10 to 20 lakh rupees is what he had given me. And That's it. And then I knew, one thing I'll tell you is that the ability to take risk, it doesn't come naturally to everyone, because people are too attached to money. And to lose money is the last thing that they want to do, which is why a lot of people, I'd say about 95% of people, would rather have safe capital lying in fixed deposits.
Yes.
But in a fixed deposit, you'll only make that 6% or 7% of the returns that you'll make. Some will go out to tax. While in equities, if you're okay to risk capital, that is, if you're okay to lose capital, the upside in equities can be manifold. Like some of the stocks that I invested in have been up 20, 30 times.
Over what time period?
Not in a very long time horizon, like in a period of 4-5 years.
20, 30 times.
And I've seen multiple such cycles.
Wow.
Point being that to the ability to risk capital, the ability to be able to lose money, or to have that mindset that I'm okay to lose money, allows you to make a ton of money. However, if you are stuck in that rut that I don't want to lose any money, this is my capital, I want it retained, and then I want some money over this, then you're going to only make a small amount of money. You're not going to make a lot of money. You're going to remain in that rut. To break out of that rut, you have to risk it.
Before we move ahead with the video, if you're an entrepreneur or freelancer watching this and you're still managing your business on 15 different apps and Excel sheets, I genuinely feel bad for you. Because back when I started the 1% Club, I made the same mistake. So when you start a business in India, you think the hardest part is getting clients. No, the hard part is what comes after. Sending invoices on one app, tracking payments on another, managing accounting separately, and building a website somewhere else. By the end of the month, you don't know if you actually made money or lost it. That is exactly why Odoo powers today's video. And honestly, I wish I had this when I was starting out. Odoo is an all-in-one business management software that gives entrepreneurs like you and me a single platform for invoicing, accounting, project management, and even website creation all in one place. Let me show you how simple this is. Say you've delivered work to a client and need to raise an invoice. On Odoo, It takes a few seconds, literally. Put the client details, add the service, payment terms, and taxes gets calculated automatically. One click, it goes directly to their email. And here's the kicker. You can get the whole suite for just 580 rupees per month per user. Click the link in my description and get your first Odoo application free for life. Yes, free for life. Do yourself a favor and stop running your business like it's 2010. Now, let's get back to the video.
You said that all the wealth that you've built, came from you, which means you were on a salary and whatever you could save, you've invested. When you are on a job, when you are having a salary, it's very difficult to get rich. Like, yes, being a millionaire, probably I could do it at the age of 55 or 60 by saving up every month. But being an ultra HNI is very different. You're orders of magnitude richer than a millionaire. So how exactly did that happen for you from being a 9-to-5 job guy to becoming an ultra HNI?
You have to think differently. And again, I tell you that out of the 100 people who worked with me, maybe 2 people thought differently. They had fire in the belly, or they had that kind of desire that I had to be rich. The first point is that you have to have that passion, that desire to be rich, right? I don't think too many people
Really?
in a corporate job have, firstly, that passion that, like you're Arjun and you can only see the eye of the bird, which is that you have to reach there. To have that kind of dedication towards becoming rich, and of course, you're, by virtue of you being in an AMC job, having your clients become rich. That sort of dedication, that sort of fire in the belly, I'd say out of 100 people, 2-3 people have.
You're saying 98% of the people don't have the innate desire to be rich.
They have a desire to be safe. So for instance, in 2008, the Lehman crisis happened. And this was sometime in September, October of 2008. In August of 2008, I had lost my sister. And it was personally a big setback. Emotionally, personally, very big setback. And it just shakes you. I mean, something like that happens. Only if you've gone through it will you realize the magnitude of what really happens when something like this happens. And then Lehman crisis happened. Things started falling off the cliff. And in that month of October, you had stock markets, that is Sensex, going down 6-7% per day.
Per day?
And then if you looked at the broader market stocks were going down 20-30% per day. And so if the world is going to hell, really nothing matters. What did I do? Despite the personal sort of setback, I told myself that I know that I'm grieving just now and it's really painful. But I want to look beyond the grief and think of the times that I have just now, the extreme distress in the markets that I have just now. And I know that this will, either the world will go to hell, and if that doesn't happen, this is probably the bottom in the markets. And from here, you'll make a lot of money. I used my salary, which was really a cash flow that I was getting, to take a loan. I took a loan and I invested in the markets at that time, in the time of crisis. I made probably 7-8 times my money in the next 1.5 years.
Wow. So how do you sort of rebalance this portfolio? Let's say, for example, let me ask you a question. Like, since when have you been managing your family office? How many years?
2.5 years.
2.5 years. In these 2.5 years, what is the highest volatility that you've observed in your portfolio?
So my portfolio being down 25% in the last 1.5 years is the highest volatility.
That's the highest volatility. Now, when something like this happens, obviously you said that things are available for cheap, you can double down, but a lot of people don't have the additional surplus lying around. And even for you, probably are already invested in all of these stocks. So my question is more around, are you keeping a certain amount of cash always ready to deploy for opportunities like this? And are you also taking some calls on, okay, let me sell those stocks because there is a better opportunity over here. While those stocks can still grow, this looks like a better opportunity. So I'll sell that and come here. So I want to understand that process.
Very valid point, Sharan. And I think that this is a very incisive comment or thought. So I'll explain this by an example. After COVID, everything moved online. So for instance, you were doing Zoom calls, internet, tech space became very important, right? And as a result, if you looked at the tech stocks in that phase of March 2020 to say October, November 2021, they went up 6-7 times. Almost all of them, right? The large caps would have gone up 3-4 times, small caps 6-7-10 times, right? Now, first is that this same stock was available at 1/3, 1/5 the price till 1.5 years ago. Have the numbers moved up 5 times? If earnings have not moved up 5 times and the stock is up 5 times, earnings are up whatever 50%, clearly that is because of multiple expansion. 2 elements to a stock. One is the earnings, the other is the price to earnings, right? The price to earnings is a perception of the business's future. Earnings are reality.
Yeah.
Right? So the perception of the business's future has gone up because of the earnings in recent times going up and things having moved online in the tech sector. How much of that perception is reality is the art aspect of investing.
That is the art.
That is the art aspect of investing. Now, if this stock used to trade at 10 times price to earnings, for previous 10 years, it traded at 15 times. So at 10 times, it is trading at a discount to that average multiple over the last 15 years or 10 years, right? However, today, if this same stock trades at 35 times, then it is at a significant premium to that average.
Yeah.
Right? And that tells me that the perception of the future is running ahead of itself. Now, I could be wrong. Maybe it goes to 40 times also. But do I want to risk my capital at a stage like that where it is already a large part of the value has already played out?
But sometimes there is future growth also that can be expected, by looking at the PEG ratio, right? So that's where people go one step further by looking at the future growth potential.
See, what happens is that when you are buying something at 35 times price to earnings, in the anticipation that future growth can be 40%, then for your own sake, it will better come at 40%. Because if it comes at 35%, and there is disappointment in this name because of that 5% differential, the stock will be half. However, if you're buying a stock at 10 times earnings and the market is expecting 20% or say 15% earnings growth, if that earnings growth comes to 12, 13%, the stock will probably not go down by much. So the game is not to get carried away by the quality of a business, but to be able to value that business and to understand that my own psychology is playing tricks with me. And my psychology is playing tricks with me how? That in recent times, this stock has done very well. Multiples have gone up. My psychology has told me that because of this business will continue to do very well. While that never happens. So on my example of the tech sector, people who were buying in I don't know if you were following the tech sector at that time, but people who were buying in 21 October, November, in the next 1 year saw 30 to 50% decline in their stock prices. And this is in a much loved tech sector where everybody was highly convinced that the world is moving to tech. Just like today, the world is convinced itself that the world is moving to artificial intelligence.
Yeah.
So even here, I can very well see that there is a bubble building up.
In AI.
Correct. So when there is over enthusiasm in a particular segment of the market, be doubly wary of that segment. And when there is over bearishness in a segment of the market, that is where I want to run towards. At least to analyze that this bearishness, is it real or things will turn around and it's just temporary.
So let's talk about the AI stocks. Because today there is also a trend among retail investors to invest in the US companies. We're talking about the Magnificent Seven US companies, companies like Nvidia, Google, Tesla, Microsoft. What would be your expert opinion on investing in these stocks right now?
I can tell you what I will do.
Yeah.
It is for everyone else to take a call on what they will do, how they think about these things. But whether it is a tech company, whether it is Magnificent 5, Magnificent 7, or it is a steel company, or it is a very ordinary brick and mortar company, all of them are businesses. And each business has a certain value. Now, if you overpay for that value, you are hoping that a bigger fool will come and buy from you at a much higher price.
Right.
You have been a fool to overpay for an asset, and you are believing that a bigger fool will come and he will pay a higher price. At the end of the day, that is a business. And if you're underpaying for a brick and mortar company, in fact, you are getting value. So in my experience, I have seen that value coincides towards, or price coincides towards value in the long term. In the short term, it can vary by a margin and that can continue for a long period of time. But in the long term, price and value converge, right? In this construct, I would not be an investor in the Magnificent Seven at the current prices. I think there is too much ebullience in that segment of the market. There is
So what you used?
ebullience, too much excitement, too much,
Frenzy.
sort of frenzy towards that segment. Whether it is institutional investors or it is individual investors, they all know the most apparent story that these companies are going to do very well in the future.
Yeah.
So everybody has loaded on to that segment of the market.
Right.
Now, what that does is that there is over ownership in this in the Magnificent Seven, and because money has moved out from brick and mortar companies, brand plays, consumer discretionary plays, that segment of the market has actually come down in ownership quite significantly. So there, if you look at the valuations, those are very reasonable. Here, valuations are very expensive. Their valuations are very reasonable. So it's a very divided market in the US. I look at some of the stocks there, and it's a very divided market. I would not be investing in Magnificent Seven. I think that they are overowned and they are also fully priced.
So as an ultra HNI investor, what does your portfolio look like in terms of geographical diversification?
Nearly all my money is in India.
Interesting.
I mean, I'm bullish out of my head.
100% in Indian stocks.
I have one stock which is overseas, but other than that, I have 100% of my money in India. If you are living in India and you are going through these times that we are, it is a path-breaking time in India. And if you're a young kid and you're not bullish on India, you're doing yourself the biggest disservice. You can't be anything but bullish out of your head for India. This country is going to go places. Of course, we can shoot ourselves in the leg. That can always happen.
Yeah.
It wasn't always like this. I've seen times when we had 12% of India's public sector banks' assets being NPS. Loans were given to people who were not deserving. We've seen in this country inflation levels at 10-11%. And for protracted periods of time, we've seen in this country that I remember in Kotak, we were building a new office and we needed furniture for that office. There was no one in India who could manufacture that furniture. We had to go to Malaysia to buy that furniture and get it to India. So we've seen a time when manufacturing in this country of any scale was zero. And from there to today, where nearly 40% of the smartphones that are used in US are manufactured in India. We were importers of smartphones to the extent of nearly $3 to $4 billion. Now we are exporting 40% of the smartphones in US from India. And it is not just about, so the perception generally is that parts of these smartphones are imported from outside. Even on that count, a large proportion of internal parts of these phones are exported from India to China even. So from a phase where we couldn't get furniture 10, 12 years back to a phase where we are exporting 40% of US's requirements of smartphones, it is a world of difference. So the vision at the top and how it percolates down to the economy, to the country overall, is what decides how the country moves ahead. And I've seen that change. It is a stark change between day and night that has played out in the last 10, 12 years. Unless we shoot ourselves in the foot again, I think that this country is going places from here.
So how could we shoot ourselves in the foot? You kept saying that multiple times. You were looking at some kind of a mistake that's looming at large, which we could
I'm not looking at a mistake which is looming at large, but politics is always unpredictable. You don't know what can happen, right? 29 is the next election. If this policy direction shifts after that,
it's a question mark.
Of course, it's a question mark.
So, would you agree on the statement that if everybody has the same insight, then nobody makes money?
I don't agree.
So, help me understand. So, when you are looking at long-term investing, how does everybody make money? What I'm trying to understand here is that typically what we think of great investment opportunities are something that is an insider information. You know it before everybody else. Now, because you understood that before everybody else, you got it at a lower price. And once everybody gets to know about it, the price has already gone up and you made money.
No, I don't agree with that as well.
Can you change my thoughts on that?
Sure. There are 3 edges that you can possibly have.
Okay.
One edge is that you have insider information, which because of insider trading rules has been, it is very risky for someone to have insider information. And secondly, if you're relying on insider information, your process is flawed. Because then you are always waiting for that insider information for you to make money.
Yeah.
So that is one aspect. The second is you have better analysis of the same situation. Now with internet, artificial intelligence, so much data being available, smart people analyzing stuff, even there you don't have much of an edge. Because everybody is analyzing the same data set in the same way or using the same inputs, they are analyzing that data. Unlikely that you can bring an edge against a really smart person sitting on the other side. So this is the second aspect. The third aspect is...
The second edge is basically analyzing information.
Analyzing information better than the other players in the market.
But you're saying that is also tough to do.
Very tough, no, because the seller on the other side is also analyzing the same data and he's as smart as you, if not more. So why will he sell it to you if there is value there in his analysis?
Right.
Correct?
Like for you to buy something, there needs to be a seller. And if somebody has put a sell order, it means that he is bearish and you're bullish.
Correct. And if he's as smart as you are and he's analyzing the same data, then he will not sell at that price if you are bullish, right?
So he has his very strong counter thesis to yours, which could play out more than yours.
So that takes us to the third aspect. The third aspect being behavioral, where how you think about a situation, how you think about how you are able to control your own biases and think about a construct in the markets. That is the durable differentiator.
Okay.
What I mean by that is that if you are someone who has a trading mindset and who's always looking to make money with the capital that is deployed, then every 5% decline in your stock price will unnerve you and you will want to sell out. On the other hand, if I am someone who's taking a 3-year call and I'm saying that I don't know whether this stock, when I buy, will go from, I'm buying it at 100, whether it will go from 100 to 120 in the next month or it will go to 80. But I know that in the next 3 years, if price and value are to coincide, then this stock, $100, should be $200. Then I have an edge over you.
No, how? Because if you have that insight that this stock is underpriced, then won't other people also have the insight because you are looking at the same data?
Of course they do, but their behavior is making them approach that opportunity differently.
Why? Can you give an example here?
So I'll tell you, I was in CCI club and I was sitting with 2 other investor friends, right? And we were discussing stocks. I had just bought this optical fiber company that I told you about. And I mentioned to them that I have bought this company, I'm very bullish on it. And I think for XYZ reasons, this company should do very well. I gave them the data. However, in their head, they overweighed the fact that this business, optical fiber business, is a cyclical business. That there are times when there is overcapacity in this business, and there are times when there is undercapacity in this business. So we don't want to take a position in a cyclical business. They did not understand that this is a stock or this is an industry which is at a cyclical low. And from here, the cycle can only be favorable, which is something that I overweight. They underweight, right? And as a result, despite my telling them that I think this is a great company, one should look at it, they did not look at it. And in the next 2 months, the stock is 3 times the price. So it's very recent. I can tell you that, the same data, and I shared my analysis with them, yet they did not invest. So how you approach an opportunity is also, is really the durable differentiator.
So let us say you had this hypothesis. Now, even you cannot be like 100% sure it will play out, right?
Which is why I don't invest 100% of my money in one stock.
Correct. You go maybe up to 10% of your money. Now, there is a counter thesis for everything. Now, their counter thesis was whatever it was, due to which they did not take that decision to go ahead. Now, how do you ensure that the thesis that you have on any investment that you're making is consistently right? Because I know probably your win rate will not be 100%.
Surely not.
Right? But if your win rate is less than 30%, then there is a problem, right? Unless your risk-reward ratio is very high. So
Absolutely.
how do you look at that?
Very valid point, very valid question. So, Charlie Munger used to say, and he used to quote Bernoulli, the mathematician, and he would say, invert, always invert.
What is that?
Invert, always invert.
Okay.
What he means by that is that Bernoulli had a hypothesis for his mathematics, right? To arrive at that hypothesis, he would first invert his hypothesis. He would say that my hypothesis is wrong. And then he would work to negate the negative hypothesis. If you can negate the negative hypothesis, then the hypothesis that you had first is right. So even in the stock markets, when I'm looking at a certain business or a certain situation, then I want to first ask myself that this is my thesis, but what could go wrong? And then I have like 3 or 4 points that could possibly go wrong in my thesis. I want to serially negate those points. If I can negate those points, then my prior thesis was right.
But you'll have a bias, no? Always. Like say you had an initial hypothesis. Then you're like, I'm going with the antithesis of this.
Right.
Now, because your initial hypothesis is that it's a buy, it's very easy for you to debate on why the antithesis might not play out. So bias will come in, right?
To some extent, you're right. But the reason that I'm going for an invert strategy is because I know that I have a bias. Because I have this hypothesis, I do have a bias. And I want to negate that bias. It is precisely for that reason that I want to look for counter thesis. Right? And as long as in my head I'm well aware that this is there can be multiple ways in which my biases can play out. One of which, I mean, the most common one is as people call this bias herd mentality, and in technical terms it's called social proof, that if everyone is selling, then obviously this should be right.
Right.
That is a bias that afflicts everyone, even me.
Yeah.
So that is one. The second is that there is a recency bias, that if the stock has not done well recently, then that must be right.
Yeah. So there is always going to be a bias across different things. But how do you eliminate that bias?
So I tell myself that these are biases that I have, and and not only me, everybody in the markets has these biases. And then I need to ensure that as little of that comes into my investment process as possible.
So I am somebody who likes to create rules in my head. Right? Like if this happens, this should happen. If this happens, this should happen. The more I talk to you, I realize that I cannot make rules out of this. It's an art.
It is an art.
Perfect. Anshul, now let's move on to the rapid fire round. We've come to the final stages of our conversation. So I have a few quick questions which I want to ask you. Cool. My first question is, what is that industry in India that you would absolutely avoid right now?
I don't look at investing like that. There is no industry, unless I don't understand that industry, there is no industry that I would totally avoid.
No, but right now, if there is an industry which has very strong headwinds, like for example, let us say IT industry, probably going through a structural breakdown because of massive changes in how the world is moving in terms of the value of human resources for IT services. So that's from where I was coming at.
I understand. See, even IT industry, for the moment, it does look like things are very bad. And to a large extent, what this has led to is for the froth to get cleared out. IT industry was so much in focus, so well researched, that everybody was in the IT sector. Also, it was a large part of the index. So perforce people were to be in that index. And some of that froth is coming down. Ownership is coming down. Now, it is times like this that you get opportunity also. Of course, I'm not saying that one should just go in and buy at this time, but precisely at these times is when you should start scouting for opportunities. There are certain names in IT sector which are trading at, even today, after the correction, are trading at 35, 40 times price to earnings.
Still rich.
Still very rich. And there are other names which are down to 15 times price to earnings. Now, if things are not going to be as bad as the market assumes that they will be, then you have an opportunity. And I'm not in the camp that believes that the IT sector will become obsolete. I think that companies will, by virtue of AI becoming so important, companies will need to re-architect their businesses where they can use AI for different applications.
Yeah.
Who will do that for them? Either they build teams within the company or they use experts who can give the right prompts.
Yeah.
Who are those guys going to be? They're going to be the IT sector itself. So for IT sector, it may mean that productivity of individuals has to move up, and hence you may see some amount of job loss or optimization of jobs within these IT companies. But the sector, in my judgment, is not going to go obsolete. It's going to sustain. And at some point when the dust settles, there is going to be opportunity there. So what I'm trying to tell you is that I wouldn't look at a sector and just summarily dismiss it. Any sector. I may dismiss companies, I may dismiss situations. But there are always situations and companies in all sectors where opportunity may reside.
Got it.
You just have to look deep enough.
A stock that you regret not buying.
These friends that I was telling you about, with whom I was sitting and I recommended that optical fiber cable company,
Yeah.
they recommended to me CG Power
Okay.
in 2020. And I just ignored it. Also, there was a lot happening, so I didn't pay enough attention. Stock went up 30 times in 1.5 years.
Wow. Damn. So smart friends you have.
I have very smart friends.
One recent trend in the markets that you do not agree with.
I think we've spoken about it. I don't think that buy at any price is a policy. I don't think that any asset class, how much ever attractive it is, at a given point in time, that you can pay any price to buy that asset class. And the Magnificent Seven, the AI boom, and the kind of multiples that people are paying to buy some of these companies, I can foresee what's going to happen. When the froth compresses, the pain is so substantial. And many times in bubble formation is also a requirement. It is a good thing that bubbles are getting formed.
Yeah.
Because sometimes these bubbles are getting formed in segments that are important. And because bubbles are getting formed, capital availability is there. And so some quality companies can take advantage of that capital and grow big. While when the bubble bursts, of course, the weak ones go out of the system and some of the good ones, they also suffer temporarily. But this bubble formation process is a good process. I think that some of that is getting formed in tech and in AI. We are in, I would not say initial stages, I would say mid stages of formation of that bubble. If it gets crazier than this, then at some point these will be very nice shorts. I don't agree with this trend of buying at any price. How much ever interesting and quality company or segment that you may be investing in.
What is your biggest investing edge in one line?
My ability to be not caught by dogma, to have and in my initial stages of investing, I was caught by dogma. I had dogma about what kind of investments are right, what kind of investments are not right, which are wrong. All of that I've learned from. When I look back and I think about how I was thinking then, I know that wasn't right. And so I've learned from that. I have flexibility in my thinking now, and that helps me to be a better investor is what I think. My ability to detach myself from money allows me to make money.
And the last question, which is the book which has had the biggest impact on your investing journey?
Can I name 3?
Yeah, sure.
One is Rich Dad Poor Dad, Robert Kiyosaki. Second is One Up on Wall Street.
He was the first guest, by the way, Robert Kiyosaki.
Is it?
Yeah.
Oh, okay. His book really had a meaningful impact on how I thought about money, right? One Up on Wall Street. And the third was You Can Be a Stock Market Genius by Joel Greenblatt.
So guys, thank you so much for watching till the end. Please feel free to drop any questions that you think I missed out on asking down in the comment section below. That will help me become better at what I do. And feel free to also drop your own guest recommendations down below, and we will try our level best to bring them on a future conversation. On that note, I'll see you in the next one.
Before you go, guys, if this video gave you even one insight and made you feel differently about money, don't just keep it to yourself. Share it with your friends or family member who could use it too. And if it has sparked a new thought or even made you disagree with me, drop a comment below and tell me why. Your critique helps me make this conversation sharper and more useful for you. As long as you have me subscribed, I'll make sure that you walk away with one new thing every Wednesday and Saturday.